Hey Dave, how you doing today?
Not bad, Nick. How are you?
Fantastic. Opening day of baseball today. Big
It
day
is.
in Michigan.
It is, and it is only lightly snowing outside.
Yeah,
So,
there you go.
so it's
Spring is
actually not
here.
the worst opening day weather I've seen. So, you
Yeah,
know,
very true. Very true. So, interesting topic today. We're going to talk a little bit about the psychology of money today.
yeah, drawing mostly from a book by the name "Psychology of Money," written by a guy named Morgan Housel, and it's been around for a little while. And I first heard Morgan speak, I think, in 2018, and read the book right after that. Um, but it lays out a lot of really neat concepts that I think, and you agree, that are really good to help think about your money.
Yeah, absolutely. I read it. I've been hearing about it and finally got around to reading it late last year, early this year. And there's just a whole bunch of different nuggets that just
Yeah,
intuitively made a lot of sense that I think will be helpful for people to hear from us and kind of explain and hopefully be able to use in their own financial planning.
right, right. And a lot of these, yeah, they're concepts that I think we've tried to work to help clients understand over the years, and I just am not as eloquent as Mr. Housel. So, so it's nice to have a well thought out book that walks you through it.
Yeah, absolutely. So I think we'll definitely put a link to the book in the show notes. So if you like some of the stuff we're talking about today, feel free to please check out the book. It's a great read and something that I'm sure we'll come back to several times in kind of our financial planning and in this podcast. So what I guess with that, Dave, you want to take a shot at some of maybe what your favorite parts of the book were?
Well, to start with, he kind of lays the groundwork by pointing out that retirement as a concept in human experience is very, very new, and that like 401ks have only been around since 1978, Roth IRAs since 1998, index funds are about 50 years old. These things that we're trying to help people understand aren't um, things we've got a lot of cultural, like a long cultural history of understanding. And kind of in the background of all that is that so much of modern finance goes against what our brains were evolved to deal with.
Yeah, absolutely. You think about retirement. I mean, retirement in general is kind of a new phenomenon. As a part of Social Security when that was enacted way back then. Before then, there was kind of work and death. There wasn't a whole lot
Right.
of retirement wasn't this 30-year experiment. It was maybe a couple
Yeah.
years where you couldn't work anymore, and
Yeah.
hopefully your family took care of you, something along those lines. So even retirement in general, let alone retirement planning as we see it
Yeah.
today,
The
relatively new. And I think you're right about the, it's, we're not, finance, our brains aren't wired to kind of think that way because it's so
right.
new.
Right. Yeah. 1870s, I believe, was when the first pension plans were developed, and that was in Germany. And the idea, and I don't think this book goes into this too much, but just by way of background, the idea was to make room for younger workers more than anything, just to encourage people to leave the workforce so that younger to help solve an unemployment problem. So, it's
Right.
not
And then,
something that the human mind has been trained over millenniums to understand.
yeah, absolutely. I mean, and we talk about the 401k, the Roth IRA, the Roth IRA only 30 years. So we haven't really thought too much, or excuse me, less than 30 years. We haven't really thought too much how to integrate things like that into financial planning, into retirement planning. So it's
Right.
ever evolving. But, I think the good thing about this book is kind of, laying the groundwork for maybe how to think about some of that stuff a little bit differently than looking at it from the pure aspect of this is a numbers game and this is kind of what the
Yeah.
numbers bear out.
Yeah. And a lot of what he does in the early part of the book kind of dispels a lot of the misunderstanding around investing. I think some of the things that stood out to me were, the idea that so much of we're kind of like trained to venerate these like so-called brilliant investors like Warren Buffett, and that's an example he uses in the book quite a bit. And he points out that so much of that comes down to just doing the right things over and over again for a long period of time. Not necessarily luck, but the fact that the power of compounding works if you give it long enough.
Yeah, absolutely. That was kind of a really eye opener when you think about the Warren Buffett story and kind of where he's at. Yes, he's widely
Mhm.
considered one of the greatest investors of all time, if not the greatest. But a large majority of that is the fact that he's also been able to do it well into his, what is he, coming up on 90 now? So, and he started in his 20s.
Younger than that, actually. Yeah. And so he's got all this time on his side. And so the laws of compounding returns worked in his favor. And, we like to think there was some kind of genius behind it, but it was really more just repeating good things over and over again rather than making a lot of brilliant moves. And
Yeah, I think he does a great job of summing that up. One of the things that I wrote down in my notes on this book that he said was, good investing isn't about earning the highest returns. High returns tend to be one off events that are hard to repeat. Good investing is more about getting a pretty good return that you can stick with and which can be repeated for the longest period of time.
uh,
So, that's letting compounding run wild by getting decent returns, not, trying to beat your neighbor.
Right. Well, and taking that a step further, and and probably everybody who listens to this podcast knows I'm a sucker for a good Napoleon quote. But the author quotes Napoleon as saying, being a good general is doing the average thing while everyone around you is losing their minds, and that's really what he gets at with this train of thought on investing is that if you can just consistently do the average thing while everybody's losing their minds about the what's going on in the news and what's going on in the markets, if you can just keep doing the right thing over and over again, you'll be miles ahead.
Yeah, and it's so interesting because intuitively we all kind of know what the right thing is, but it's not that easy. Of knowing what the right thing is isn't the hard part. That's kind of the
Hmm.
easy part. Doing it and living it is a whole different story. I remember being in this business back in 2008 and knowing that, sticking with it and not selling and not, changing, altering course because things were really
Oh yeah.
bad was the right thing to do. But that doesn't mean that my emotions didn't get in the way and think, maybe I'm wrong, or having those moments of doubt while it's happening.
Oh yeah, I tell this story now, but at the time I didn't share this with clients. But in the middle of 2009, I remember after a particularly hard day of like the fourth or fifth client leaving my office, I'd given the same speech about waiting for the recovery and things would turn around, and calling a another advisor who I had worked with before but wasn't in my office, and just saying, "Are we still, do we still believe what we're saying?
Yeah.
you know, are, am I still okay saying this over and over and over again for the last 18 months? Because it doesn't seem to be getting any better." And yeah, it can be. The market will try you and try your patience, and you've just got to keep doing the right thing consistently over and over again, regardless.
Yeah, and kind of related to that is just kind of this concept that he talks about, which is the survival mindset of financial
Mhm.
planning. The biggest thing there is, being financially unbreakable is more important than
Yeah.
big returns. And I think what he means by that is, making sure that if you have a period of bad returns, you can survive that is more important than being a brilliant investor that can get these humongous returns, because
Right.
humongous returns don't mean anything if you can't keep them, or if when things go bad, you go bankrupt financially. And that's, I think, an important concept that sometimes we forget when it comes to
Yeah.
investing, is
Yeah.
that basics of, making sure that you're on stable ground before you even think about, getting better returns, so to speak.
Right. And we're right back to where we always are on these podcasts, where we're talking about, making sure you have a contingency fund in place, making sure that not all of your money is in the market and at risk, because just when you need it most is going to be the worst time to take it out. And so he talks about a barbell approach and having, taking long-term risk for retirement and things that are long ways down the road, but in the short run, being very, very careful and very, very safe. And that's the same concept we talk about with clients every day.
Yeah, absolutely. It's so important. And I know we kind of even joke with ourselves about the fact that we can't make it, 15 minutes into one of these without talking about contingency funds. But,
Right.
that's how you become unbreakable financially, is having a good contingency fund, having cash in the bank for when things happen, making sure you're properly insured when it comes to, transferring the major risks of something like a major health accident, car accident, to insurance companies, so that, if something bad happens, you're not going to, basically ruin everything that you've built on the investment side.
Right.
And another thing that he puts in there is, planning is important, but more important is planning on the plan not going according to plan.
Right.
So, nobody plans financially on being in a car accident or being disabled, but, making sure that you have those contingencies in place for those things. So if it doesn't go according to plan, you're, unbreakable when it comes to the basic stuff, the boring stuff that,
Yeah.
doesn't get the headlines.
Yeah. Well, and part of that, is not just being ready for whatever the world throws at you, but also recognizing that your own preferences and goals for the future are going to change and evolve. We're really, really lousy as a species of it, figuring out how our minds are going to change over time. And we need to be adaptable and have our finances be adaptable.
Yeah, and it's just this concept of, and I think he touches on it in the book of, we kind of, our minds aren't designed to forecast our own futures very well, in terms
Right.
of, I can kind of forecast where I'm at right now and where I might be in the next couple of years, but, I have no idea what I'm going to be or where I'm going to be in 30 years from now. And that's kind of essentially exactly what financial planning is trying to do, is to, predict where you're going to be in a long time from now. And that's just not, we're just not very good at that.
Yeah.
And so
Well, and
instead of trying to be good at it, we try to make sure that we plan on not being good at it, so that when things ultimately change, as they, that most of the time they do change, we're ready for that change.
yeah. Yeah, and we see it every day. We'll talk to a client when they're 60 and planning to retire in a couple of years, and what sounds like the ideal day in retirement will look totally different after they've been in retirement a couple of years.
Yeah.
So,
Absolutely. I
and
mean, yeah. I mean, you work your whole life to retire, and then, I always tell people, you think about retirement as this target date, and you're doing all these things your whole working life to get there. But how much time do you think about what in the world you're going to do when you get there?
yeah, so I like the concept he put forth, to kind of help with that, of thinking of your life in 20-year blocks and your finances in terms of 20-year blocks. I think that's a useful construct around that.
Yeah, absolutely. It just helps to kind of break it down, because it's so hard to vision outside of that.
Yeah, yeah. So, you know, um, what a couple of the little gems about investments and life planning that I thought were really salient was he talks about how you need to recognize that you may be investing your money and your friend may be investing their money, but you're not necessarily playing the same game with the same goals and the same. So what's right for them or acceptable to them in terms of the risks and what they're doing doesn't mean anything to you, and doesn't need, you can't get into this comparison game of how you're going about implementing your plan.
Yeah, I think that's so true. And, if you turn on the TV, you turn on CNBC or even the nightly news, a lot of times, the information that's coming in from these people it just doesn't, frankly, just doesn't have anything to do with your own personal
Right.
situation. So, what Jim Cramer picking stocks has nothing to do with, what's happening in, or what should be happening in your
He's still
personal
around.
financial plan or your portfolio. I'm pretty
Right.
sure it's still around.
Yeah, I'm
And neither
curious.
does the hedge fund manager that makes the front page of news in the Wall Street Journal talking about his projections or what they're
Yeah.
doing has literally no bearing on what you're doing because
Or,
they're playing a completely different game than what you are.
or even in a more, I guess maybe another way to apply the same idea is, investing in rental real estate may be the perfect thing for your neighbor to do, but just because they're successful at it doesn't mean that it's the right thing for you. And that there's lots of different answers, and we can't get too caught up in what everyone else is doing. Just keep your head down and keep doing what you're doing. And another one of my little favorites that I'm stealing from here in client conversations is that you've got to remember wealth is the money that you didn't spend.
Hmm.
And therefore, it's the invisible result of not spending your money. The guy that rolls up in the brand new Mercedes Benz, people have a tendency to look at that and think, oh, he must be very, very wealthy, right? And all you really know about him is he's got a shiny car that cost, $100,000. You don't know if he's got another $100,000. Um, and all you know is that's the car he chooses to drive. But we tend to look at those kind of things and think that they are the outward signs of wealth, when real wealth is the money you didn't spend on the car or the big house. It's the result of not doing those things. And that real wealth, as the author looks at it, is control of your time and being able to do what you want to do.
Yeah, absolutely. That's so true. And if you want to keep score with, what your neighbors are doing, you should definitely do it in terms of, not necessarily wealth, but in terms of money or the amount of money or the toys that they have, but more along the lines of control of time, because that's the only
Mhm.
thing that everybody's on the same playing field, right? We all have the same number of hours in the day and same number of days in the week. And so, your control over that is really the true definement of your quote unquote wealth. Not that you should, be comparing yourself to your neighbor, but if you were going to, that'd be a much better use of your time to do. It would be, your use of time as opposed to the money that you have or what you spend it on, for sure.
Yeah. Yeah.
So another thing that I thought was really interesting about this, and it kind of relates to some of the stuff that we're talking about of, the news and comparisons, is this idea of seduction of pessimism. And
Yes.
so, it's this, if you look at the news, you say that we're going to have a big recession and newspapers are going to call you up and you're going to be on the front page. Say
Right.
you're headed for an average growth and nobody really cares.
Right. Right. And we're dealing with that right now, right? And part of that he points out is like bad things that happen tend to happen all at once, where good things, and then we're talking about finances here. The good things, back to Warren Buffett, accrete slowly over time, right?
Hmm.
And so here we are 3 months into kind of a negative market right now. and everybody's focused on that, and everybody's kind of on edge about it. But we are coming off of 3 years of astounding market growth that just happened a little bit every day over time, right? And
Yeah.
that, of course that happened. That's what's supposed to happen. The market's supposed to go up, no big deal, right? But boy, you know now we're down a little bit from that peak, and it's engenders so much more pessimism than the other generates optimism.
Yeah, absolutely. It's the concept of loss aversion, right? Most people are, more concerned with losing than they are necessarily with gaining, and that
Yes,
affects them more than, so a 10% gain affects them less than a
yeah,
1% loss.
yes.
And so,
Yeah, Daniel Kahneman did great research on this, and that's another book that's my favorite non-investing investing book that we should talk about another day. Is his Thinking Fast and Slow, but he worked very hard on that, on the psychology of loss, and how people our reaction to loss is much more acute than our reaction to gain.
yeah, absolutely. And that, he kind of breaks it down. Morgan Housel kind of breaks it down, in talking about investing, that you must identify the price of success and
Yeah.
volatility and loss amid the long
Yes.
backdrop of growth. That's the price, and you have to be
Yes.
willing to pay it.
Yeah, and this has come up a couple times in the last couple of weeks with conversations with clients. We had all the good outcome for the last 3 years, and now we're paying the price after the fact, and that kind of makes it feel a little bit more acute. I think that we've already had the gain. Not like you pay the it's not like you pay the price at the same time, if you will.
Yeah, well, great. Thinking back to our conversation on inflation, that was, one of your main points on inflation, and as it relates to the market.
Yeah, yeah. Um, so there's so many good things in this book. I think we could probably go on for hours. One of the where was I going with this? Along the lines of the uh, with that the idea of optimism and pessimism, and he talked about imagining an alien coming down and evaluating our economy on New Year's Eve of 2007, and then again on New Year's Eve of 2009, and looking around and thinking everything looked very much the same. You had people out in Times Square reveling. You had the same number of offices and the same number of office buildings, and everything looks very much the same. But several trillion dollars of investments were wiped out in the meantime, and housing values had slunk. And the only thing that had really changed was the way we thought.
Hmm. Yeah.
And that it was, that economically we were pretty much just as well off as before. But we went from believing that home values would keep going up to feeling like they were worthless. And, the stock market got cut in half, but all of the economic potential was still there. And the thing that came to my mind as he was saying this is really what we're getting at with that ability to not make mistakes, is being able to bridge that gap of understanding and wait until people come back around to, where the economy is actually headed.
Oh yeah, and I think, in more than that too, we have so many scenarios where people kind of, complain about the times that we're living in and don't really think about how really phenomenal and how easy we have it compared to where we were, 100 years ago, let alone 25 years ago, and with the
Right.
technology that we have, and how we haven't really had any wars in a long time, like the world wars, and it's really crazy how we can be so focused on what's happening today, and not really put it into a long-term perspective.
Yeah. Yeah.
Kind of along those lines too, I love some of the stuff that he talks about with history and history of the markets,
Hmm.
and kind of one of his big things is history is mostly the study of surprising events, right? So the
Right.
normal
Right.
everyday stuff doesn't make the history book. It's the
Right.
surprising stuff that happens. And the mistake that we make, especially as investors, is we use that as a guide to the future in
Yeah.
terms of what the expectations are. And when really the correct way to view that is what you need to learn from surprises is that the world is surprising.
Yes. Yeah. There's
So
a quote in there, like, new things that have never happened before happen all the time, I think is the way he put it.
yeah, I think that's a Scott Sagan quote.
Yeah.
And it's just so interesting, and it's funny, being in this industry long enough. And one of the things that we hear, and one of the things that came out of 2008 was, everybody lost money. And then so what happened is we started coming up with strategies for how do we not lose money in 2008. And so we'd
Yeah.
even go back and we'd backdate these strategies and be like, look, if you just did this in 2008, you would have only
Right.
lost a little bit of money, or you would have made money. And then we try to say, well, that's what you should do in the future. And inevitably it fails because the past isn't going to repeat itself the way it
Right.
has. It's going to be something different. And whatever worked back then, it's easy to backdate it. And, you tell me what time period you want to live through, and I'll tell you exactly how to invest and what to invest in. But that's
Yeah.
not the way the world works. That's not how the future is going to work. And to think that it is a big mistake.
Yeah. Yeah. Um, that all brought to mind another great book out there that we can talk about someday is Nassim Taleb's Black Swan. And I saw a headline not long ago. I didn't read the article. The headline was something like it was something that was happening. Is this the next Black Swan? But the idea being, they talked about the financial crisis as being a Black Swan event, one something you'd never expect, and it's like by definition, if we think something is going to be the next Black Swan, it's not a Black Swan, right?
Right.
And with the point of that digression being, whatever the next financial crisis is going to be, it isn't going to be anything we've thought about. It's not going to be anything we've imagined. It's not going to be anything that compares to crises that we've seen before and learned to manage, because they wouldn't be a crisis the next time around.
Yeah, absolutely. And I kind of think back to, there's always somebody that quote unquote predicts the next downturn, right? So in
Mhm.
2008, there were people that kind of knew what was happening with the mortgage backed securities and all
Yes.
that. But even they had no idea the ramifications and how that would affect the
Well,
economy. They just knew that there was an issue.
so yeah, the Big Short, great
Right.
great movie and great book, Michael Lewis, about a few handful of hedge fund guys that saw the financial crisis coming. But the other shoe to drop that never got talked about is every day there are hedge fund managers making the same kind of bets and thinking certain things are going to happen, and they're wrong. And I always think of what Grandpa used to say, even a stopped clock is right twice a day. And
I
you
love
know
it.
so yes, if you predict gloom, if you predict bad things long enough, eventually you're going to be right once. But if in the same time you govern yourself as though that's going to be the norm every day, you're never going to get anywhere.
Yeah. Well, to be frank, they don't make movies and they don't write books about people that were wrong about their predictions of
Right. Right.
what's going on
Yeah.
in the economy.
There was a follow-up story on one of those hedge fund managers, and I can't remember his name, but it's the um, well, I can't remember which one it was, but he basically has made a whole bunch of things moved since then, and regarding oil and different things that were just, not, let's just say, not nearly as brilliant.
Yeah. So, one last thing I'd like to cover real quick, Dave, is this concept that he brings up, which is margin of safety. And the
Hmm.
purpose is to kind of render your forecast unnecessary.
Right.
And that's something we could probably even do a full podcast on, but it's definitely something, when we're doing financial planning, we're always trying to put in a
Yeah.
margin of
Yeah.
safety.
Yeah. That was when I was reading that, I thought, okay, yeah, that's built right into some of the software we use, using Monte Carlo simulations and things to kind of take the guesswork out of what's going to happen. to kind of say it's going to be a wide range of outcomes. We know we're never going to be exactly right in anything we forecast, but we want to make sure that whatever those that within that range, you're going to be okay.
Right. And the bigger picture, how that what that translates into is when you have room for error, then you can endure that range of potential outcomes, right? Because we can't,
Right.
we never project your future based on a perfect market that goes up 8% every year. And because of that, if we don't get 8% a year, then we can really, kind of mess things up. And so that's where building that margin of safety so that we can go through and make sure that you can stick with it when in those lean years when it doesn't go according to plan.
Yeah. Yeah. So great book. I think there's something in there for everybody that wants to pay attention to their finances and understand them better, and think about how they think about money.
Yeah, and I think it's so important. I would highly recommend picking it up and taking a look at it because it really does break things down into intuitively make sense, and it starts to help shape the way you think about these things, which is so important because if you don't start shaping the way that you think about these things, the danger is you're going to
Well,
rely on what you know, right? And there's this great quote in here that says, your personal experience with money maybe makes up 0.0000001% of what's happened in the world, but maybe 80% of the way you think the world works. And
right, right,
so by educating yourself and thinking about and doing reading and personal finance is really going to help kind of strengthen your resolve to get through the lean times, to get through the bad times. And as we've discussed, that's, a big part of success financially is being able to do that and being able to by being able to think about those things in the right perspective.
yeah, yeah, for sure, for sure. Well, good discussion.
So
Yeah,
yeah, great, always fun, great book. And if our listeners have questions, feel free to shoot us an email at info@srbadvisors.com. We, as you can tell, we love talking about this stuff. So if you have questions, give us a shout. Dave, it's always a pleasure. Until next time.
yeah. Thanks, Nick.